very warm welcome to everyone. I am Shrija Agrawal, and you are watching yet another episode of Mints Inside. Rahul, how are you looking at economic slowdown? There's also concerns about getting into a global economic slowdown. We really have corporates coming to the fore, requesting softs from the government. There seems to be an atmosphere of gloom and doom at large. So, what are you really making of this?
See, there are a few issues at hand here. One is that, to my mind, the single most important issue in India is the fact that our monetary transmission has been very weak. So our M3 as a percentage of GDP has been declining every year for the last 4 years. And that will inevitably cause a slowdown. Why is this happening? Because one of the issues is that we had effectively about 5 years ago 3/4 of the banking system which had wiped out its capital. Most of the public sector banks that are included. Now, when that happens, what happens is that every time they get some money back, they're unable to relend it, right? So effectively, the broad money in the economy starts to decline. The monetary velocity starts to decline. That is a very serious structural problem which needed to be compensated for, and there are various ways in which RBI could have compensated for it, but I feel that they haven't done it adequately. But on top of that, we also had a whole series of reforms, whether it's RERA,
IBC.
Right? IBC. And now, if you think of RERA, what does the government say? The government says that a builder cannot pool the capital. He has to spend that money on the project for which he has raised money from investors. Now, that's very good and it's great governance. But if you look at it, that money was being turned over far more. Now suddenly it cannot be turned over as quickly, and therefore the monetary velocity declines. You have IBC, which frees up so many factor assets. When you free up so many factor assets, what happens? The supply of factor assets go up significantly. You are reducing the pricing at which the markets clear in the factor markets, right? You also have a lot of real estate inventory. Now, the real estate inventory, power sector, these are what I call these are over investments from the last cycle, which you're actually seeing. And you're seeing investments which have taken place at very highly inflated real estate prices. And these are on the back of leverage. So these markets are not clearing. Now, one other issue with real estate prices falling and the markets not clearing is that a lot of lending to SMEs, etc. in India happens as against property that the entrepreneur has or that business owns, whether it's their office, etc. Now, when these markets don't clear, that lending also dries up. Again, you have a drag on monetary velocity. You clean up all the chit funds and you clean up the black money, etc. It's fantastic. It's the right thing for the economy to do and for the government to do. But again, this was providing a layer of liquidity which has suddenly disappeared. Now, in this context, a lot of Reserve Bank of India's models which predicted M1 to M3 transmission don't hold because ceteris paribus doesn't hold. But my belief is that they have not adjusted for the new structural changes which have taken place in the economy, and which is why you have this tightening of liquidity, and which is why every industry in the country is feeling it. And you're seeing different manifestations of the same phenomenon, right? The other thing I mentioned earlier was the fact that the government has moved a little bit too much to the left. And as a consequence, instead of investing more and incentivizing businesses to invest, grow, and create jobs, etc., they have been probably deploying way too much capital as a proportion to helping the disenfranchised and the poor. Now, this will always be a political tug-of-war for any government, but I just believe that at this juncture, we have gone too far to one side. The other issue is in terms of taxation. We've impeded monetary velocity there too, because we have put a tax on dividend distribution, we've put a tax on buybacks of shares, and on top of that, we're charging a tax on people receiving dividends. Now, what happens is that if a business doesn't need money, it redistributes it and that person can then reinvest it. But if to move money from A place to B place, you start actually imposing a tax or a cost for the mobility of capital, you start impeding it, you not only destroy factor mobility, but you actually are impeding productivity and growth in the economy, right? So I guess there is a mix of fiscal and monetary issues which are creating this kind of environment. And to be quite honest, I think that the government has to take cognizance of it and course correct to some extent. And I think that's very necessary.
So my last question to you, Rahul, really is that the entire thing about fintech. We are seeing so much interest from investors at large into the fintech landscape. But China fintech has really kind of gone kaput, and we really have this major IL&FS crisis right now, and we're seeing the hangover of this. Do you really think what really is kind of eating the financial services space from within?
So again, two phenomenons according to me. I think one phenomenon is that if you look at the financial services space worldwide, it really took off, and the market capitalizations took off. And I'm not talking about the insurance industry, but the lending industry largely. It took off from the early 1970s. And the reason it took off is that if you look around the world, the leverage ratios of these financial institutions started to go up significantly. Now, what does that do? It very simplistically, if I borrow at 10 and lend at, let's say, 15, just for argument's sake, then I have a 5% spread. That 5% spread has got to pay for my people cost, my operating cost, my risk cost, right? That there'll be some amount of credit costs associated, my taxes and my profits. That's if you have one time you lend the money that you get, which you borrowed at 10, but if you do it twice, then suddenly that spread is not 5% but 10. If you do it 3 times, that spread goes to 15, and therefore your people costs can expand, your technology costs can expand, your profit starts to go up. And as leverage ratios moved from 3-4 times to as much as 30 times in a lot of the global financial institutions, you had a lot of this profit pool or the spread pool expanded very significantly. Since 2008, every regulator in the world has been, as part of the reform process, has been making the leverage ratios decline. Right? And this, to my mind, has impacted the financial sector industry around the world. On top of that, add to the fact that you have come up with fintechs of various nature who are eroding away, who are targeting very specific profitable parts of the entire financial ecosystem, targeting it, going after it and eating away the market share. Now you would understand that new businesses will always target the most profitable parts. So there's disruption taking place and they're cherry picking these businesses. One of the things which is happening to my mind is that right now, the only beneficiary of all of this disruption is the consumer, who's effectively getting a better deal cheaper. It will tantamount as the markets clear and stabilize and there are clear winners and clear losers who come out. There will be businesses who will capture some of that value. But you have to remember one thing, and this is true of a lot of the disruption economy. It's very easy to disrupt. It's not that easy to create a sustainable profit pool post that disruption. Yeah. And I think that sort of the ultimate sort of thing that all us investors look for is disruption with an associated profit pool, which is sustainable.
Thank you, Rahul. Thank you for talking to us.
My pleasure.
With that as a thought, disruption, but also in hand with sustainable business model. Thank you for watching us. Till the time we see you next. Goodbye and good luck.